Welcome to Power Charting. I am your host, Bruce Frazier. On the knife's edge, our stocks ready to run. On the knife's edge is a play on words, which we will explain in greater detail in a minute. But it's also an important concept that is in play right now. Very critical point in time for the stock market. In my estimation, I'll show you why. And with that, brief announcement, Best of Wyckoff Unconference 2023. Roman Bogomazov and the Wyckoff Analytics team is going to put on a two-day conference in San Francisco at Golden Gate University, July 13th and 14th. It's going to be an epic event. I get to be a guest speaker at that event. It's going to be an unconference, as Roman likes to describe it, because it's going to be very non-traditional in the way that it's set up. A lot of interaction with Wyckofians, with the speakers. There's going to be great events on both days. The great William Reardon and Roman Bogomazov are going to do an intraday tape reading workshop on day one. In the afternoon, Roman and myself are going to do a swing trading workshop. And then the second day is full of all kinds of really great events. So with that, please have a look, wyckoffanalytics.com, and check this out, find out more there. Now, on the knife's edge, this is the New York Stock Exchange Index. I believe I showed this to you in a galaxy very far away many years ago. And let's bring this up to date and talk about it currently, because it's an exceptionally interesting and I think impactful, important index and the way it's setting up at this time. The reason it's called the knife is because it's the New York Stock Exchange index of all common stocks on the New York Stock Exchange, including REITs and ADRs. And this index was hugely popular in the 80s and 90s because there was an important futures contract that traded on this index called the knife. And so it's an index that probably isn't as important today or doesn't get as much attention because of the huge impact of the mega cap stocks, which are mostly or almost all on the NASDAQ stock exchange or the NASDAQ stock index. And so not to say that this is not an important index, because these are older staid blue chip companies that have been around a long time. And this chart, this index, this long-term trend has something important to say to us right now. And with that, let's have a closer look here. Let's make sure my pen works. And I want to show you how we calculated this trend line. This is the 74 low back here, this very deep low, followed by the 82 low. Using the Wyckoff method for trend line construction, we're creating a demand line under the market using these two adjacent lows, both of which came on extreme financial economic stress. The 74 bear market was the worst bear market that we'd had in inflation adjusted terms since 1929, which was a deflationary depression. This was more of an inflationary, might I say the word depression, probably more considered a recession, exceptional loss of purchasing power for stock investors in that bear market. We draw an intervening high right here off this peak, and we have a trend line and we have an overbought line. We call the lower trend line the demand line. And notice how these very important highs and lows seem to respect the trend line analysis. We have another parallel that we draw off the 87 peak, which resulted in the 87 crash. and the crash went right down to the overbought trend line where it held and then continued on into this big, what I call this bull market peak. And this bull market peak was the 2000 dot-com stock mania. And this really was a psychological extreme of huge importance in the market as a whole, as the dot-com stocks really got crushed, more so than the New York Stock Exchange stocks. This decline here was a bear market of epic proportion, especially for the NASDAQ names, which in many cases went down 85, 90%. Some went to zero. This is the bull market that followed. And this bull market again went back to an overbought condition above this upper overbought line, which resulted in the decline into the Great Recession in 2009. And then the bull market, which was an exceptional bull market and better actually in the NASDAQ names than in the New York names. I'll show you that in a minute. But this expansion, this bull run, which lasted about a decade, more than a decade really, culminated with the decline that took us into the COVID low 2020. And now here we are in a recessionary bear market low in 22, October of 22, and attempting to rally back up. Now, I want to make a couple of key points about this index because we're looking at a 50-year trend. This is a secular trend of rising stock prices. Very important. Now, the key is, and the point I want to make, and the reason that we're on the knife's edge, what happens if we break this secular uptrend as defined by this trendline analysis? I contend, and we are looking at log scale. This is a log scale advance in stock values that we're looking at. So here we see that we're crowding up again, up against this demand line. And every time we've hit this demand line from underneath, which is these red arrows, we can see that the Fed came in and effectively re-liquefied the system, brought down interest rates, expanded money growth, created an easy money environment, and that created what appears here to be like a V bottom for these stocks. Now, there's actually great accumulation structures under these V bottom lows, and I would go back and study each and every one of them as a Wyckoffian or a technician. Notice that each one of these thrusts upward in this New York Stock Exchange index after the 2009 low has a diminished momentum to it. You can see the thrusts, the upward thrusts are diminishing on the rise, even though it's staying above its demand line. It can no longer get to the blue dotted overbought line that we see up here. And that is a demonstration of the slowing momentum of the market late in the bull market cycle. So the 2022 low, which is the one that we are coping with at this time, I've shown with a yellow arrow. What is different here from all of these prior lows with the red arrows? Well, generically, these lows were all accompanied by a Fed that started to seriously worry, and a U.S. Treasury that worried about the economy, financial stress, banks that were failing, and started to prop up or support the system where prior to that they may have been not accommodative, restrictive in their policy stance. And that helped to propel the market into a new bull run. So here I use a yellow arrow simply because so far it appears that the Fed is taking a continuation of a restrictive policy, which they effectively started after the bear market began. in 2021. They didn't really start to address or attack the inflationary conditions until after the stock market was already starting to have important weakness. Now we have high inflation. We have a Fed that's not accommodative, a Fed that's still threatening at next week's meeting to raise interest rates. Again, they may or may not. All of us are guessing about that at this time. But we have the banking system showing that classic stress that is showing up at each one of these declines just from the top to the bottom of our trend channel construction. And so all of these declines all have economic cracks in them. And so here the Fed is not yet apparently responding to those economic cracks. I believe that they may be starting to change their position and becoming more accommodative on maybe a stealthy basis. And so we will have to watch and see their comments coming out of next week's meeting, and their policy decision to raise or not could be very, very important for the market. Turning to this chart on the right, you can see here, and I highlighted in yellow, is that this is just simply a blow up of the last few years going back to 2015. And at this time, you can see that this rally has gone back up to the demand line, but continues to reside below it by a fraction. Now, this may not be the case at the end of April when we get the final day of the month, but we want to see, for the sake of this secular advance, this index get back above that all-important 50-year long demand line. And that's just me maybe being a touch wishful, but also being very, very clear that this is like an important line in the sand, because if we see the market start to fall away from the level that we're at in the NYA or these other indexes, which I'm going to show you in a minute, then we have to be very, very worried that we have a different kind of a stock market at hand now than we did before, as defined by these prior red arrow periods. And so we are going to watch this like a hawk. And again, now I'm going to make the case right here, because we're going to zoom in on that chart on the right to the area that I highlighted in yellow. We're going to take a very brief look at these indexes. Zooming in, we're going to look at the S&P, not the New York. We're going to look at the S&P, and we're going to look at the NASDAQ 100. And we're going to ask ourselves the question, are conditions internally at the current place in this market cycle such that we could have a rally of importance out of this area, which we really would like to see for the sake of the secular uptrend. Now, I'm just going to show you this very briefly. You've seen this chart many times in the past. This is up to date through today, April 27th, when I'm recording. But this is the NASDAQ 100. And we looked at this in October on this show, on power charting. We pulled this up when it was below that demand line and said, gotta hold. This is the place where it needs to hold. And in fact, it did just that and had a good rally. We had great swing trading advances from this low, and you can see that it is, and I'm going in here, I should really use my highlighter to help this area here, which I'm going to show you in more detail in just a second, is it's rallied back up in. So we picked the right time to look at this index in October on the show, but it's back up in, and it's attempting to run back up to the top of the channel line, which is not the old highs, but that doesn't mean it couldn't get to the old highs. But we would probably need some help from the Fed. Down here, this is just the SIBO put call ratio, 10-week moving average. Quite long-term look at this data set. Secular extreme pessimism, here at the low in 2009. Now, this trend channel only is constructed from 2010, 2011 lows with an intervening high to give us this channel. Look how beautifully it works. So these concepts work on a fractal basis. They work in many time frames. I'm just stunned that 74 to 82 period in the knife shows us such a beautiful uptrending channel that captures the essence of this secular advance. And keep in mind, 74 lows, just for those of you that like to think about these things, 1971 was the year that the gold window was closed and the dollar was no longer backed by gold. So 71 to 74, very short period of time in that index. And then after that, there's just a secular advance that goes and goes and goes for 50 years. Could that have been related to the Fed and the Treasury being unshackled by the really the demands of a gold-backed currency? Something for you to think about. I actually have a funny story about the closing of the gold window in 1971, maybe for a future episode. But here is the S&P 500. This also 2011 and 2015 are the primary points that we're drawing this trend line off of. Beautiful trend channel that goes up into the 2021 peak, throws over both the Keltner channel and the trend channel, becomes overbought. And we showed this chart at the time that it threw over the top of this on this show. I mean, it's like, you got to stick with me here, because, you know, we keep an eye on these things. And I love the really long-term perspective. So I know for some of you, it's just like, oh, ho hum, this is just such long-term. It's like watching paint dry. No, it's not. And I said at the time that if we fell back into the channel and below the Keltner from this level, that we could have a very fast decline back to the bottom of the channel. Well, lo and behold, that's exactly what happened. And so here we are flirting with this lower channel line, which is the oversold line in the way this is constructed, but hanging right there. So this is really kind of telling the same story as the NYA at this time. But look at how this sort of has the characteristics of a potential base here. So let's have a closer look with the 8 minutes I have left. I just want to show you seasonality. My friend Dimitri Speck, founder of Seasonax, who makes this great seasonality chart tool, is going to be speaking on a webinar at IFTA, May 25th, 1 p.m. Eastern Time. You are invited. Go to ifta.org and register, and it's absolutely free, and you're going to enjoy it. Dimitri does a super job. So anyway, here's 73 years of history, only pre-election years. You've seen this chart before. I've just updated it to the present. I've used the NASDAQ 100 here because I think it actually, it's a little bit closer to what the seasonality looks like. So you can see here the relationship of the seasonality trend. Now, what we show, let's get into the future because we don't have a lot of time, is that when May starts, which is right here, that we get about a half a month of weakness, and then we get a run up into July, into early July. So this is like into the end of the second quarter. So that seasonality, after a couple weeks of flat to down in May, we have positive seasonality, and this is the best run of the year until we get into the months of November, December. And you can see the monthly average returns. So interesting to watch, and we'll keep an eye on that. Now, this is interesting. I'm just going to pull everything up because I'm running out of time. This is this decennial pattern. And this, again, was constructed by Dimitri. It's a beautiful. Now, I'm taking data back to 1897. And so I didn't make this chart, Dimitri did. And so he generously has allowed us to look at it. And here you can see the 2 years. So this is 2020, 2021, 2022. And note this yellow shaded area is a decline, weakness in the market. This is the worst weakness in the market of the 10-year decennial pattern. And into 2022, in the third quarter, you get an important low. When did we get our important low? In 2022, we got it at the end of September, beginning of October. So this seems to be tracking. The only difference is that we had weakness that started at the end of 21, and then we had weakness into the end of the third quarter of 22. Now, look at the characteristic here. This has sort of an accumulation type characteristic, and so does this. Here we are in 2023. Remember how we talked about into May to July that we have some seasonality positive? Well, look here, we have seasonality that takes us up into about the mid part of the third year, and then sideways into the end of the year, and then strength in the last 6 weeks of the year. Very consistent. These are two different approaches to seasonality. Very consistent with what our other seasonality tool is telling us. And so far, the market seems to be obeying this process. Now, let me just note that the election year 24, the fourth year in this case, not all fourth years of decennials are election years, presidential, but the really good uptrend begins in the fifth into the sixth and seventh years. So that is where, you know, the real broad strength comes. But we're going to have to take this day by day, week by week as we go. But the fourth year is kind of a trading range year. But we still have potential for strength in the third year. So let's keep an eye on this. Not going to talk about this today, but I am going to get into accumulation. And so you'll be able to see here, I actually put this accumulation schematic here so you can see it, and go to my written blog, Wyckoff Power Charting Review, in July 1st of 15, and you can read up on all these definitions that we have labeled here, and haven't completely labeled the right side on purpose, and those we may add those at a later date. I have pointed out that there's huge resistance here above the market. This is the S&P, and this resistance is defined by literally a year ago. So we've been in a range-bound condition in the market since May a year ago. And even though it seems like we've had tremendous weakness all the way into October, which we did, it was in the construct of early accumulation potentially. So I'm making the case here that stocks could be setting up for accumulation. I've had these discussions with you in prior episodes. Want to point out that we did not get overbought on this run up, but note how there's really been a subdued, this is stocks above their 50-day, subdued breadth in the rally up to this resistance zone, and this resistance zone is very much still in force. Now, this came after an important thing happened. In January, we broke above the bear market supply trend line. So important strength. Then we tested it from above here, and this is also where the 200-day was. So two important things happened. Now the 200 days turned up, and we're still above the trend line. What I have said in the past and continue to believe, and this could happen momentarily, is that we need a rally that takes us into the resistance zone to the August highs or higher would be preferred, which we would call a major sign of strength, and then some kind of a shallow, narrow, low volume pause that would result in a more important rally. That would be ideal. Now, there's a couple other ways this could go, but this sign of strength that we need up here, let me just draw that in, is very, very important. And so this is something that we're watching for, but this is all occurring on or below those all-important demand trend lines on those long-term charts that we just studied for trend analysis. And the NASDAQ is stronger than the S&P at this time, which I think is fantastic. So notice that the NASDAQ 100 in April was able to rally above the level of the May high from a year ago. This is acting better, had a better rally starting in January, and has been stronger up into resistance. We still want to see this level literally knifed through, using our term today, and to get into this resistance and show that in fact all of this accumulation, well, is in fact accumulation, because accumulation effectively shows absorption as being complete. Stock is in strong hands. And so with that, we are out of time. It's been great that you've been here. I hope you enjoyed this trend line analysis. We're going to watch it like a hawk. Very important time. The market is truly on the knife's edge. And with that, thank you for being here, and we will see you next week.